A credit default swap, CDS, is a derivative contract that transfers credit risk from one party to another without transferring ownership of the underlying debt instrument. The buyer of protection pays periodic premiums to the seller of protection in exchange for compensation if a specified credit event occurs. CDS contracts allow investors to manage credit exposure separately from bond ownership, making them important tools in modern credit markets. The underlying borrower is known as the reference entity, while the debt obligation upon which protection is based is called the reference obligation. CDS contracts are widely used for hedging, speculation, and credit risk management. Several key terms define the structure of a CDS contract. The notional principal represents the amount of debt being insured, although it is not exchanged between counterparties. The protection buyer makes periodic premium payments, known as the premium leg, throughout the life of the contract. In return, the protection seller agrees to make a payment under the protection leg if a credit event occurs. Common credit events include bankruptcy, failure to pay, restructuring, or other contractually specified events affecting the reference entity. These provisions establish the framework through which credit risk is transferred and managed between market participants. Settlement procedures are critical components of CDS contracts. When a credit event occurs, settlement can take place through either physical settlement or cash settlement. Under physical settlement, the protection buyer delivers an eligible defaulted bond to the protection seller and receives the bond's par value. Under cash settlement, the seller compensates the buyer for the difference between the bond's par value and its market value after default. The amount received by the protection buyer reflects the realized loss on the reference obligation. These settlement mechanisms ensure that CDS contracts effectively provide insurance-like protection against specified credit losses. CDS pricing is primarily driven by the probability of default and the expected recovery rate of the reference obligation. A higher probability of default increases the likelihood that the protection seller will be required to compensate the protection buyer, resulting in higher CDS premiums. Similarly, lower expected recovery rates increase potential losses following default and therefore raise CDS spreads. Market participants continuously evaluate these factors based on issuer fundamentals, economic conditions, industry trends, and market sentiment. Consequently, CDS spreads serve as real-time indicators of perceived credit risk and often react rapidly to changes in credit quality expectations. In addition to default probability and recovery assumptions, several market factors influence CDS pricing. Changes in interest rates, liquidity conditions, risk aversion, and overall economic outlook can affect CDS spreads significantly. During periods of financial stress, investors often demand greater compensation for bearing credit risk, causing CDS spreads to widen. Conversely, improving economic conditions and stronger corporate fundamentals tend to narrow spreads. Liquidity also plays an important role because less actively traded CDS contracts may command higher premiums. As a result, CDS pricing reflects both issuer-specific credit risk and broader market conditions affecting investor demand for protection. The relationship between CDS spreads and bond credit spreads provides valuable insights into market pricing of credit risk. Both measures reflect expected default losses and compensation for uncertainty. However, differences may arise due to liquidity factors, supply and demand conditions, and market technicals. Analysts often compare CDS spreads with bond spreads to identify relative value opportunities. If CDS protection appears expensive relative to bond spreads, market participants may infer that credit risk is being priced differently across markets. Monitoring these relationships helps investors assess market sentiment and evaluate whether securities are trading at fair value relative to their credit risk. One of the most important uses of CDS contracts is hedging credit risk. Bond investors can purchase CDS protection to offset potential losses associated with deteriorating credit quality or default. This strategy allows investors to maintain ownership of a bond while reducing exposure to adverse credit events. Financial institutions frequently use CDS contracts to manage concentrations of credit risk within loan portfolios and fixed income holdings. Because CDS contracts separate credit exposure from asset ownership, they provide flexibility in risk management and enable institutions to adjust credit risk profiles without buying or selling the underlying securities. CDS contracts are also widely used for speculation, relative value trading, and portfolio management. Investors who expect a borrower's credit quality to deteriorate may purchase CDS protection to profit from widening spreads, while those expecting improvement may sell protection and earn premium income. Portfolio managers use CDS indices and single-name CDS contracts to adjust overall credit exposure efficiently and implement tactical investment views. Although CDS markets enhance liquidity and risk transfer, they also introduce counterparty risk and leverage considerations. Understanding CDS features, pricing drivers, and applications is therefore essential for analyzing credit derivatives and managing credit exposure within the program.